All right. Hello, everybody. Happy 2025. Here we are. As the waiting room starts to empty out and people filter in here, you might see a box or two pop up on your screen. But in the meantime, it's 6:30, so I figure we'll get started. And those that are late, well, that's their problem. So welcome. We're excited to see all of you and hope everybody had a great holiday season, of course, and happy and healthy 2025 to you all. This is a really timely presentation, and I look forward to doing these at the beginning of the year because one, it's just a new starting point. Two, especially going into this year and actually the past couple of years, it seems like everything is so data dependent and time sensitive, and markets across the world are reacting very quickly to new information that comes out more so than ever. And well, today's inflation report is a good starting point. But before we get to that, I want to introduce our speaker. Um, that's Eric Parnell. He's the chief investment, or I'm sorry, chief market strategist for Great Valley Advisor Group, and he is, very key in managing many of the portfolios that you guys have with us, and one of the individuals responsible for helping us with asset allocation, investment selection, manager selection. If you have stock selection, him, his team, and members of the investment board, of which I am a member, have a lot of input into how these portfolios get crafted, managed, and hopefully perform over time. So that's one of the key reasons why we bring Eric in, because it's our opportunity to let you see one of the guys behind the curtain that is instrumental in helping us do what we do for your guys' benefit. Um, and I think, it's important for everybody to understand the affiliations that we have with Great Valley Advisor Group, and they function as what's called our Registered Investment Advisor, or RIA. And I'll try to shy away from the alphabet soup that tends to plague our industry. But they serve many functions, some of which is, more back office stuff, operations, compliance. But one of the divisions that we leverage heavily is the asset management function. And that's where Eric and his team come in. And he has a team of now four or five, in addition to the investment board, that are responsible for trading and managing and playing a key role in our portfolio management solutions. And so this is your opportunity to, as the presentation goes on, to ask him questions and, talk to the guy rather than hearing it come from me. So without further ado, I will let Eric introduce himself, and hope you guys enjoy. And by the way, I'm gonna put the chat on, so if you guys have questions and you don't want to interject, you can type questions in the chat. I'll be watching that throughout this, and we'll certainly leave time for questions and answers. But don't feel shy to jump in, unmute yourselves, and give us your 2 cents as we go along if you see something that it piques your interest.
All right. Well, thank you, Paul, and good evening, everybody. It's great to be here with you tonight. As Paul mentioned, I am the chief market strategist from Great Valley Advisor Group, and Paul and I and Preston and the team at Nexa work together in collaboration in terms of managing, among many things, managing the investment portfolios for your various accounts. So it's a great working relationship that we at GVA have with Nexa, and I'm excited to be here tonight to talk to you during what continues to be an interesting time for the economy, for financial markets. Hard to believe we're already 2 weeks into the new year, and a lot's really taken place over the last 4 to 6 weeks. So we're going to delve into, kind of where we are with the markets right now, what we can reasonably expect over the course of the next 12 months here between now and the end of 2025. But as Paul mentioned along the way, if you have any questions or things that I bring up that you'd like to delve deeper on or kind of explore a different path on, definitely let me know, because this is your time to and our time together to explore the topics that are of most interest to you. So please feel free to jump in at any point along the way. But with that, I'm going to share my screen and have a few slides that will just kind of illustrate some of the points that I'm talking about here as we start off the new year. So the first chart here is this is a chart of the S&P 500 index. So thinking about monitoring the markets, you have the Dow Jones Industrial Average, you have the Nasdaq, and then you have the S&P 500. The S&P 500, it's one of those trick trivia questions. The number of stocks in the S&P 500 is actually 503 stocks because there's a couple stocks that are duly listed, like Google, which has two different share listings. So you have 503 stocks in the S&P 500, but in many respects, it is a good representation of what the stock market, the US stock market, is doing at any given point in time. And one of the things that really stands out, this is true going back to Halloween of 2023. We could even go back further and say it's really been true since the middle of October 2022. And that is that the US stock market continues to be in a steady uptrend. One of the things we have the chart here, the S&P 500, and that is that jagged black and red line that's moving to the upside with all the numbers around it. What we also have here on this chart are what are known as trend lines. This is referred to in the investment industry as technical analysis, where you're using a variety of different trend lines in order to inform and help be able to see where the market should reasonably be at any given point in time. So going all the way back here to October to basically Halloween of 2023, we had a correction that was taking place from August 2023 to October of 2023. The market bottomed right around Halloween, and we had a strong rally into the end of the year in 2024 or in 2023, and that has continued with only one or two brief setbacks. The first half of April, the middle of July. Basically, this is a market that's been moving steadily to the upside in all through 2024 and into the start of 2025. But that
this is
raises a
something
natural.
that, Eric, if you don't mind, I jump in because this is one
Absolutely,
of the
please.
talking points we have always in the conference room when we're talking about market trends and volatility. And 2024 was, by most people's definitions, a very good year, right? The S&P, this index, was up over 20%. It was a pretty low volatility year by historical standards. And still, you see these couple of pullbacks. So when we're having these conversations about, in the midst of one, and we say, hey, it's normal. The whole two steps forward, one step back analogy, our markets have really been doing almost 3 or 4 steps forward before taking one step back lately. And you could see even in a short period of time, and if this chart was extended out several years, you'd be able to see it more clearly. But there are these pullbacks that we do expect, and it's part of a healthy market. The froth gets taken off the top, and it gives investors a chance to reset. So you're seeing that here. And again, we don't bring up charts a lot in the conference room. You guys all know that. But this is one way to look at that and say, oh, yeah, these pullbacks are normal, but on a point-to-point basis, we tend to end up in a better place than when we started.
Yeah, I mean it's such a great point, Paul, because it is easy at any given point in time to see the market pulling back. I even think about what we've been in the midst of lately since December 1st. I mean, winter for the stock market came early this year. One of the things that we had been talking about internally, in terms of the conversations that Paul and I have been having, is that, once we get into the new year, once we get into January or February, the stock market really overdue for a pullback. And those pullbacks, to Paul's point, are healthy because it gets the froth out of the market. Speculation can kind of run out of control a little bit, and it causes people to take a breather, take a pause, and reevaluate their positions. We like to see pullbacks because that's what a normal, functioning, healthy market does. And since the beginning of December, we have seen the stock market pull back, reach as high as about roughly 6,100 on the S&P 500 at the beginning of December, and has drifted lower here all the way to, last week it touched as low as 57.73. That's several percentage points pullback. It is not surprising at any given point in time to see this U.S. stock market fall anywhere between 4% to 12% over a 6 to 8 week period. That's what you see, and that actually provides good entry points, clears off the froth, allows the market to reload, and it provides those good buying opportunities that we look for along the way. And we saw that in April. We saw it again with the pullback that took place in late July and early August, and we're seeing that take place right now. And one of the things that we can say is that we could see we could see the stock market on the S&P fall as far back as 5,500 or even 5,100. So 5,500 is the red line on this chart. It's the 200-day moving average. It's a trend line, the average of the market over the last 200 days, or the pink line, which is the 400-day moving average, the average of the stock market over the last 400 days. And the uptrend in the market would still be intact. That's how strong this market has been, that it can have that type of pullback and still be moving to the upside overall over an intermediate term to long-term time period. So,
And that goes into the analogy that we often use, that the markets take the stairs up and the elevator down. Like Eric said, a 8 to 12% pullback within a couple of weeks is not terribly uncommon. But to get that on the upside, we would view a really good quarter as a 6% or an 8% or a 12% appreciation, which is 3 months. So, the evaluation period going up is a lot longer than when things fall. And that's why you often hear people say that.
yeah. So, given the fact where we've seen a pullback, a question that is reasonable coming off of today, and we're going to talk a little bit more about the inflation report that came out today, is that, was the good reading in terms of corporate earnings that came out today, as well as the positive inflation report, is that the foundation to set a bottom in the market right now? Well, that's possible. But we also wouldn't be surprised if we saw a further pullback in the next couple of weeks. But it raises a broader question to say, what can we reasonably expect for the markets as we go through the 2025 calendar year? And for that, I'm going to go on to the next slide, where we see this. Let me take me to the next slide. One of the most important elements that helps drive stock prices higher over time is the underlying economy. And the chart that we have here is it's the projections for fourth quarter gross domestic product, or GDP, for the US economy. How much is the US economy growing at this point? When we were going into 2023, one of the primary concerns among investors was, when is the recession going to happen? Well, it never came. So as we were going into 2024, one of the primary concerns that investors had is, when is the recession going to happen? And it never came. So here we are heading into 2025. One of the things that we saw over the course of 2024 was that the US Federal Reserve lowered interest rates starting in September for the first time since before the inflation outbreak back in 2021 and 2022. So the reason for them cutting interest rates in September, and then they followed through with another rate cut in November and another rate cut in December, is that they were concerned about the economy slowing and the potential for a recession as we went into 2025. But when one takes a look at the current economic data, are there signs of weakness on the margins? Absolutely. But overall, this is an economy that continues to be strong, with economic growth in the fourth quarter coming in, and the green line is the key to watch here, consistently throughout the third quarter. Projections were for economic growth coming in anywhere between 2.5% to 3.25% in terms of GDP growth. And that, for an economy as big as the US economy is, 2.5 to 3.25% economic growth, that is good, solid, strong growth. The other key takeaway from here is that the green line is consistently above the blue line. The green line is telling you what the data is predicting GDP should be, or economic growth should be. The blue line is telling you what economists, people like you and me who work in the economic industry, who try to predict what the US economy is doing. That's what their predictions are. And what we have seen continuously over going all the way back to 2022 is that the green line has been consistently above the blue line, which means that the economy continues to perform better than what economists think the economy should do. So that's a positive thing, because that means that the market has room, the economy has room to exceed expectations. And because the economy is the primary driver of how the market is doing, the stock market is doing, that means the stock market has the ability to exceed expectations as well. So economic growth remains strong here as we go into 2025. Could we see it slow as we go into the year? Absolutely. But we're starting from a strong base here, which is a good foundation for the stock market. Okay, so the next point to highlight, the primary determinant of the stock market returns over time. We hear a lot of talk about things like politics, for example. The stock market doesn't care about politics. Whether, whatever party is in power in Washington, as long as the stock market is getting the economic growth and the liquidity from the Federal Reserve that it needs in the form of lower interest rates, it has the fuel to move higher. Another one, geopolitical events. There's been all kinds of uncertainty in terms of things happening in the Middle East, concerns about things happening in Asia. The reality of it is that sometimes those things can actually be stimulative for the stock market. Can you see a short-term pullback when there's a shock event, just like when the situation broke out in the Middle East? Absolutely. But more often than not, those tend to be buying opportunities. Those are not primary determinants of how the stock market performs at any given point in time. What is a primary determinant, not only the US economy, but even more directly, corporate earnings themselves. What are the profits that companies are making on a quarterly basis as they operate in this US economy? And that's what we have here on the chart. This is the S&P 500 index and the earnings per share, the collective earnings per share of all of the stocks in the S&P 500. And how much is that growing on a year-over-year basis, like on an annual basis each quarter? 2024 was a great year for the stock market. And one of the things that we saw is that corporate earnings growth was consistently rising anywhere between 5 and 8% on an annual basis throughout the year. And we saw how well the stock market did. Well, in 2025, these orange bars, this is the forecast from S&P Global, the company behind the S&P 500 index. Basically, what they do is they aggregate, they collect the earnings forecast for all 503 companies in the S&P 500, and they figure out how much earnings are projected to grow in the coming year. And what we're forecasting as we start the year, the expectations are is for low to mid-teens in terms of earnings growth for 2025. Even if we fall short of those earnings expectations, that is still really strong earnings growth that can help support higher stock prices in the year ahead. And the next chart, just to highlight this relationship, and this raises a key point. This chart here, it's the data from S&P Global to show that relationship. The blue line is the S&P 500 index. The orange line is the earnings on the S&P 500 index, the annual earnings on the S&P 500 index. And one of the things that we see when the orange line is rising, the blue line is rising more often than not. But when the orange line is falling, like it was in the turn of the millennium from 2000 to 2002, during the financial crisis from 2007 to 2009, during COVID from in 2020, when that line is falling, stock prices also tend to fall. So there's a very high correlation, a very strong relationship between corporate earnings, how much money corporations are making, and how their stock prices are doing. Now, there's one thing that stands out here on this chart as we go into 2025, and this is one of the reasons why we say we shouldn't be surprised to see the stock market pull back, is because where we are in the stock market right now, in and around 5,800 to 6,000, we're running ahead of the market in terms of the earnings that it's generating. And these lines tend to like to converge over time. So we shouldn't be surprised to see the stock market pull back a little bit as earnings rise up along the way and these two lines meet again. So when you hear about stocks being expensive or rich valuations and stocks, that's basically what people are talking about, is that on a dollar per earnings basis, stocks are pretty expensive right now relative to their underlying earnings. So, I've hit on a number of topics here so far related to the stock market. I'll take a stop here for a second. And are there any initial questions that people have or things that they might want to explore as we go through some of these topics here tonight? Well, as always, if you do have any questions, please, let me know, or you can always drop there's the chat function here associated with our meeting. You can always put a question into the chat and we'll keep an eye out for that as we go along.
So Eric, before you keep going, I'll play a little bit of devil's advocate. We just painted a pretty rosy picture.
Yes.
Corporate earnings look good, forecasts look good. Everybody thinks we're doing well. The GDP numbers are great. So let's talk about some things that could possibly derail this, right? And
Absolutely.
politics, we'll leave that one to the side because we know there's not really a huge correlation between political policy and what gets enacted and overall stock market returns over a period of time. Again, more of a headline risk or a shock event, but beyond that, there's not really much to look forward to there. But when we're thinking about risk factors going into 2025, maybe you could touch on that, and maybe that's the next couple of slides. I don't want to steal your thunder.
No, absolutely. No, it's a great it's a great point because that's really where we're headed next is that there's good reason for optimism as we head into 2025. And despite some short-term volatility we've seen, good reason for optimism, but that does not mean that we're not without risks as we go through the year. Now, I would say the number two downside risk, so kind of do it in like a countdown fashion. The second biggest risk to the markets as we go through 2025 is we actually get the economic recession that everybody's been worried about for the last few years. I don't have a chart for it here, but one of the things that we have had for the last several years is something that's called an inverted yield curve. And an inverted yield curve is that weird phenomenon where investors can go and get paid more in terms of yield or interest rate for loaning money to the US government for 2 years. So that's your 2-year treasury note. Right now that's in the neighborhood of about 5% or 5.5% versus what they can get paid lending money to the US government over 10 years, which, around like 4.5%, 4.75%. So the question is, well, why would that be the case? The reason that investors would be willing to receive less for lending money to the US government for longer is because they want to lock in that longer term rate. Why would they want to lock in that longer term rate? Because they're expecting that the Federal Reserve could lower interest rates in anticipation of a recession. We've had an inverted yield curve 13 times over the last 100 years before the current inverted yield curve, that phenomenon where short-term yields are higher than long-term yields. Today is the 14th time, and it's been this way for about a year and a half now, but we haven't had a recession yet. 13 out of 13 times in the past, it's been right. This time we haven't had the recession yet. So, but if we do get that recession that plays out in 2025, and the reason that would weigh on the stock market is because this positive earnings forecast that we see here, that could flatten out in a hurry if the economy is going to go into recession. But economy looks strong. Number two downside risk as we go into 2025. Let's
And
talk about the number
before you
one
get to the
downside
number
risk.
one risk, because we know the yield curve and some of these metrics that we're talking about are just lines on a piece of paper to a lot of people, and trying to make that relatable to real life. And one of the best analogies to understand what a short-term higher yield comparative to a long-term higher yield is when you go to the bank and you're looking at the CD rates. Your 6 to 8 month CD rates are far in excess of those 3, 4, 5 year rates, or even the 1 year rates. And that's some of the things that we've been talking to you folks about as your CDs mature, and should you roll them over, what duration should you be picking, etc. These are the reasons that, or this is a way to correlate what Eric's talking about with respect to the yield curve to what actually affects an individual investor at the end of the day. And he's talking about it, of course, more in a predictive sense and how it has been a decent indicator of recessions. But when you think about what that means to your pocketbook and to your cash flow, to the interest credits you're receiving, that's really where you're seeing that. And that is kind of a phenomenon. You don't see that very frequently for the most of everybody's life. The longer term CDs pay more than the shorter term, and it makes perfect logical sense that you're tying up your money for longer. You should get a higher premium for that. In this environment that we're in, it is unique in that sense.
Yeah, yeah, and typically when you see the recession take place is when the yield when that relationship corrects itself and starts to become normal again because the Fed is lowering interest rates. So it's but that Paul's example is a great example of that. Your 6 month CD paying you a higher yield than your 1 year CD or your 2 year CD, and that's because people are willing to get less to lock in that rate for a longer term period of time. So that's the second thing to keep out. The number one downside risk that we need to monitor as we go through 2025 is the threat for a renewed rise in inflation. We can all remember what took place in 2021 and 2022. We came off of COVID, and COVID was a shock to the system. And the fiscal policy response from the US government, the monetary policy response from the US Federal Reserve was overwhelming in terms of the stimulus and support that was provided to the US economy. So supportive that it ended up sparking an inflation problem. It had its seeds in February of 2021, and you could watch it all through 2021, as you can see here on this chart. The problem continuing to grow. By the time we're in 2022, we have a big inflation problem in this country. We have headline inflation getting as high as 9%. We have core inflation, which excludes food and energy, getting as high as nearly 7%. So a big inflation problem. And one of the ways that impacted the market and the stock market in 2022, we saw stocks go into a bear market in 2022, and we saw bonds had a tough year in 2022. So a meaningful downside risk. And it's one that, really, in terms of the work that I've been doing, I've been talking about that being the number one downside risk for markets going all the way back to the summer of 2023. Because in the summer of 2023, the inflation problem got under control. The blue line came back down in towards around 3%. The red line was steadily moving down. The inflation problem was coming under control. And that's good for the market, because when inflation is high, it means that companies have to pay a lot of money for their inputs, and it's a lot harder for them to make profits. Their profits shrink. On the flip side, when inflation is low, then it's really easy for companies to make big profits when inflation is low. So companies love low inflation. Companies and stocks do not like high inflation because it squeezes their profit margins. And on the bond side, it makes the income that you're getting from your bonds a lot less valuable because it's not keeping up with the rate of inflation the higher inflation becomes.
And one of the points Eric made earlier was, a couple of things that the market really likes to maintain its momentum. One is those solid corporate fundamentals and GDP numbers. The other piece was liquidity, and liquidity is measured in a lot of different ways, but the Fed lowering interest rates is actually a stimulative act. And that's why when you see these economic recessions, especially 2008, 2020, 22, there were, or not 22, that caused it, but in 2008, 2020, Fed had to cut interest rates to stimulate the market, and amongst other things. But that is one of the byproducts of it, is fuel for the market. And that's one of the reasons why when you see these numbers, and like today, we came in a little bit under forecast. People recalibrated their expectations for Fed rate cuts, and buyers step back in. So you'll see that a lot when we're going through this song and dance with inflation numbers coming out every other month, and Powell getting up to speak and all that. And that's one of the reasons, is because the market is very sensitive to that liquidity factor.
Yeah, because it's such a great point, Paul, because when you think of inflation, and this is what happened in the late 1970s and the early 1980s, inflation is an issue where you have too much money chasing too few goods. Not to get all Econ 101 with everybody, but, you have too much money chasing too few goods, and it causes prices to rise because, those that have the goods can raise the prices. Well, how do you stop an inflation problem? You take money away from people so you don't have too much money chasing too few goods. But that means liquidity is getting drained out of the system. And that means that money is being taken away from people in the form of higher interest rates, so they have less money to own stocks, and they have to sell stocks as a result. So that's one of the reasons why inflation, it's tough on bonds, it's also tough on stocks. Now, one of the things that we've seen, we got to the summer of 2023, and this blue line, the headline inflation rate, hit around 3%. And we fast forward all the way to where we are now here in December 2024, we're still pretty close to 3%. We popped up here a little bit, and we were grinding along this 3% line. Then we popped below it, and we got to September of 2024, and the number was all the way around about 2.67%. Well, or 2.57%. Well, since that time, over the last 3 months, we've seen that headline inflation rate rise. Now, that's something we're keeping an eye on. We're still below 3%. And the more important story is we look at this red line. Core inflation, core CPI, this excludes more volatile food and energy. We've heard about high egg prices, oil prices and gasoline prices are always a topic. Well, for core CPI, those items get excluded because they're volatile. So this is a number that economists and markets tend to watch even more closely. And this is where we're seeing an even better story because since September of 2022, it's like skiing down the ski slope in the wintertime. I mean, we've been steadily lower. We flattened out here the last few months, which has been a cause, something to watch. But one of the reasons why we saw the stock market up so much today, headline inflation was higher, but it was that core number that fell, and the market wasn't expecting the core number to fall. So that was great news. Nonetheless, we got to keep an eye on this number as we go through 2024 or 2025. The last line I'll mention here is the green line. Unlike in the past, too much money chasing too few goods. Well, goods prices have actually been deflating. It's cost less to buy things like a car or other like a dishwasher or some of these other things versus a year ago. Where we have seen sticky inflation and where we have seen things continue to be expensive is on the services side. Going to the movies, entertainment, going on vacation, going to a lawyer. Those things have become more expensive. They bottomed out in September 2023. They rose up towards about 5% in May, and they've been drifting lower here. This is a positive sign as well. But we need to keep an eye on inflation as we go through 2025. Because if these lines start to curve back up, that means that not only is the Federal Reserve going to lose the flexibility to lower interest rates any further, which is, lower interest rates, more liquidity into the markets, help stock prices rise. If these lines start to turn back higher, that means the Federal Reserve may have to start thinking about raising interest rates again, which the stocks and bonds aren't likely to like that. So with that in mind, one of the things I always like it when I can go out and take a look at things for myself. So the next chart I'm going to show you is, say maybe you're at home and you're saying, hey, I want to keep an eye on what's going on with inflation here. So all you need to do, and this is free, is you go out into Google and you type in St. Louis Fred, not Fed, but Fred, F-R-E-D, and you can see it here at the yes, fred.stlouis.org. You go to the St. Louis Fred website, which is from the Federal Reserve, and they just have this trove of economic data. You go under their website and you type in the number 5-year break even, and it will pull up this chart for you. And you can be looking at the same chart that I'm looking at in terms of what are we looking at for expected inflation as we go through 2025. Because if you go back to 2021, before we had the inflation problem here in the US, we could see this line was steadily rising all through 21 and into 2022 before the markets even started to react. So here we are today. So this is the average expected inflation as measured by the market itself over the next 5 years. Right now, that number resides at 2.5%, which is a great number. If we see average inflation at 2.5% over the next 5 years, stocks are going to love that. We've seen this line go as low as 2%. Now, these readings here after COVID are higher than the readings that we saw before COVID. But as long as they stay consistent in that 2.5% range, the markets are going to like that. But what have we seen here recently? And this goes back to September of 2024. This line moved higher, hit 2.5, came back here a little bit, and now has started to push up here a little bit again lately. This is a good line to keep an eye on. It's fine where it is right now. But if this line starts to push its way up to 2.75 or maybe even 3%, then the market is going to start to increasingly worry about a potential inflation. And those are the types of things that can derail what should otherwise be a good year for the stock market, at least given the data that we have right now. So this, again, is the number one downside risk for the stock market, is that threat of inflation. All right. So We've talked a lot about stocks at this point. I'm going to spend some time talking about bonds because, like bonds is, yeah, it's like two siblings. You have the stock market, which is the popular brother that everybody knows and goes to the parties and everybody talks to, and then you have the bond market. They're kind of sure and steady. They're a little bit more to themselves, but can be just as interesting, if not more so, taking the time to get to know it. So we're going to spend some time talking about the bond market. But before I do, I want to take just a breather here, and see if there are any questions. And also, Paul's raised so many good points in turn along the way. Anything that anybody might want to throw into.
Hi, it's Steve. This might be off the track, but what is AI's influence on any of this stuff right now?
No, Steve, that's a great question. I would say artificial intelligence is going to be instrumental to everything. I think the most recent correlation that we've seen in our recent lifetimes was the advent of the internet in the late 1990s. When the internet came around, you knew it was going to be transformative to the way that we do business around the world, well into the future. And that has definitely been true. I think we're going to see the same thing with artificial intelligence in terms of, it's the productivity gains that we're going to generate from it, the technological advancements that we're going to generate from it. Much like the mainframe computer going all the way back to the middle of the last century, it will enable people to be so much more productive and be able to elevate the things that they're doing in terms of their research and their ability to generate profits. We have seen the first phase of that, just like in the internet. You think about companies that did so well in the late 1990s. It was the companies that were providing the routers and the switches and the modems to get on the internet. Well, the companies that have done really well since the middle of 2023 have been the semiconductor chip companies that are providing the on-ramp to get into artificial intelligence. But the true beneficiaries of the internet over the last quarter century has been spread all across the economy. The true beneficiaries of artificial intelligence, and it's going to take time for it to manifest itself, are not necessarily going to be the companies that are providing the equipment. It's going to be the companies that are able to utilize that equipment and put artificial intelligence to use. And it is going to come from all corners of the economy. So one of the things that we look at in terms of assessing where are the opportunities for artificial intelligence as we go into this second wave or this third wave, who are the companies that have just a treasure trove, masses of data that they don't know how to harness yet in terms of optimizing how they do business. A perfect example of this, and I'll go as boring as possible in terms of a perfect example of this. You think of the grocery store. I mean, very tight margin business, kind of, slow and steady. Well, what do you do when you go to the supermarket checkout line? You swipe that club card. And by swiping that club card, the grocery store is just collecting all kinds of information in terms of the items that you purchased. And, they are gathering a treasure trove of data on the tens of thousands of people that go through the grocery store every single day. The ability to use artificial intelligence and the tools that are coming into play now in order to be able to get into that data and figure out how they can, optimize how they run a grocery store will be transformative over the next 10 to 20 years. So really, from an investment standpoint, one of the things that we're prioritizing is that, where is the shiny object in the artificial intelligence space from a stock perspective at any given point in time, and also trying to anticipate, well, where is the shiny object going to move next, and allocating in advance of that.
Thank you.
You bet. All right, so let's talk about bonds here, and it's one of the things that I was a college professor for 18 years, so I'll use the same thing that I said when I would talk to my college classes. People hear the word bonds be boring. No, bonds are actually very interesting. It just depends on what types of bonds that you're thinking about. If you're thinking about a savings bond to the U.S. Treasury or something like that, well, you pretty much know what you're going to get after 30 years with a little bit of interest on top. But if you get into various areas of the bond market, there are a lot of interesting aspects to it. For example, there are some areas of the bond market, like high yield bonds or convertible bonds or emerging market bonds that trade like stocks, but with much less volatility. So they give you stock-like returns with high income, but a lot less volatility. There's also other areas of the bond market, like intermediate term treasuries. We always hear about the 10-year treasury yield, or long-term treasuries, a 30-year treasury bond. They trade like stocks. But one of the beauties about having these types of investments in your investment portfolio is that they provide diversification and provide a more consistent returns experience to your portfolio over short term, intermediate term, and long term periods of time. It is a great diversifier. When I always refer to it as like legs of the stool. If you're investing in stocks, you're basically trying to sit on a stool with only one leg. Because when you have the upside in the market, that's fantastic, and you're participating in the upside of the market. But when the market turns to the downside, it can be downright scary sometimes. I mean, I still remember October 8th, 2008, like it was yesterday. And it felt like the downside in stocks was never going to stop. And of course it did. And it's, 9 times higher than it was 15 years ago. But at the time, it never feels like it's going to stop. One of the things that's great about bonds in a portfolio is it not only provides consistent income, but it provides a diversification offset. If you were a treasury investor, a long-term treasury investor during the financial crisis, your portfolio could have been up as much as 50% along the way because the money was flowing out of treasuries or out of stocks, excuse me, and flowing into treasuries. So it is not only good in terms of providing income for your portfolio, but it is also a great diversifier to provide you with a better risk-adjusted returns experience over time. And that's a fancy way of saying a more consistent and predictable and smooth returns experience over all different market environments. So bonds are really a worthwhile complement and component to any and all investment strategies.
And it's often one of those topics that in the conference room, someone says to me, "How's the market?" Not once has someone been referring to the bond market. It is always the stock market. It's usually just the United States stock market, by the way, but it is one of the critical pieces of the portfolio. And if you think about your portfolios over the at the highest level, some of you may have up to 50% of your assets in bonds. So that's a lot of exposure and a lot of dollars in a market that really doesn't receive any notoriety. You hear about maybe the inverted yield curve if you're reading CNN Business or Bloomberg. Aside from that, you really don't see this as a ticker floating around in the corner of your local news station because they're covering the Dow, the S&P, and the major markets that garner the attention and truly create a lot of the volatility, albeit with the upside. But the bond market and the bonds as an investment and a component of the portfolios that people have is critical for us to be able to help provide that consistent lower volatility return experience over a long period of time. And don't get me wrong, bonds have not had the best 3 or 4 years. Since 2022, they have been close to abysmal. And we get it. And you look back and you say, why the heck do we even own these things? But if you stretch that evaluation window out longer, there is very clear evidence as to why we own them.
Paul, can I ask a question?
Sure.
Your audience today is made up of a bunch of different people with a bunch of different investment goals, where they are in their lifelines. How do you manage that ratio between stocks and bonds on an individual basis? And I don't 80, 20, 65, 35. How is it that you're doing that for each of your clients?
Sure. So at first it comes down to needs and resources available, right? So there may be folks that just have a lot of money and aren't going to spend it all. And we're more talking about their risk tolerance and what they're looking and how much risk they're willing to accept. So that may be the driver, is more how much risk can they handle when things hit the fan? Are they going to freak out if things do get volatile, which of course equity markets do? And for the investor, that's a little more hands off and just says, hey, I'm going to ride this wave. Yeah, we could be on the higher end of the equity spectrum, 70, 80, 90, 100% equity if we need to be. But for most people, they don't want to ride the wave to every point of the S&P, because when things do get bad, they get bad. And it's cause for heartburn. So that is part of it, is just assessing risk. When are you going to need the money and how much are you going to need over time? So if you're a retirement-minded investor and you're in retirement taking withdrawals from your portfolios, well, we got to figure out how much you need and where we're going to source that from. And then the other piece is your financial plan going to fail if we don't earn enough? Maybe you want to be conservative, and but you need to earn more. You need to earn that 4 to 6% a year, because you're going to run out of money at 78 if you only earn 2. Well, that's going to force your hand to make a decision. Am I going to cut back on portfolio withdrawals? Am I going to change my lifestyle? How am I going to accommodate that and try to find a happy medium? Fortunately, there's not a lot of those conversations that we have to have, but that would be another determining factor. Most of the time it comes down to, time horizon, as we refer to it, meaning that how much you're going to need to access in a given period of time, and your feelings on risk. And we have some folks that just are willing to accept more risk because they're used to it, and that's fine. We could allocate to however we want.
All right, thank you.
Yeah, and building on Paul's great point, Steve, the other thing is that we look at the risk tolerance for the investor and allocate to bonds accordingly. There's a lot of investment strategies out there that just kind of say, okay, we're going to put a plain vanilla allocation to a broad bond market exposure regardless of an investor's risk tolerance, and just boom, that's it. That's not the way that we see it in terms of the investment analysis that we do. In many respects, the bond market is just as interesting and diverse, if not more so, than even the stock market. There's so many unique and differentiated investment opportunities that exist in the bond market. So, if it's a conservative investor, and let's just say they maybe have an equity weight of 40% or 60%, the bonds that will own, there'll be what's known as shorter duration, which means there's less price volatility and more of a focus on income generation. And, it'll be more of a conservative bond allocation to go along with a more conservative equity allocation. On the flip side, those investors that are more aggressive and maybe they have an 80% equity weighting or a 90% equity weighting, the types of bonds that we're owning are more aggressive bonds. They have that price volatility and that pop to them that can provide a meaningful return. I even think back to the bursting of the tech bubble back in 2000 to 2002, when the stock market was falling by 45% over 2 years. Long-term treasuries were up 25% per year for like 2 or 3 years. And we had a bond market that went through a 4-decade bull market. So, those more aggressive bonds can really provide some total return to complement the stock portfolio. So that's a big part of it too.
Okay, thanks. Answered my question.
Absolutely. So where are we with the bond market today? So, we talked about the inflation outlook and the critical for stocks. The inflation outlook is also critical for bonds. But one of the things we saw in the bond market today, huge rally in the bond market today, doesn't show up on this chart. It says 4.79 here. First thing to mention about the bond chart, and I think it's one of the reasons that people don't like bonds, is that when this line goes higher on the page, this is the 10-year Treasury yield. When 10-year Treasury yields go higher, that means that bond prices are going down. So as the line goes up, that's worse for bonds. When the line goes down, that means that bond prices are going up. So in terms, flip your mind upside down, or maybe take your computer and turn the monitor upside down, because that's the way that bonds work. So one of the things, we have 4.79 here on the right side of this chart. That's where the bond market closed yesterday. Today, the bond market closed at about 4.64, 4.63. That's a huge drop in yields in a single day. That means bond prices rallied pretty strongly today. So the lower the yield, the higher the bond prices. One of the things that I would observe as 2025 is getting underway is that, we talk about stocks and the outlook is good for stocks, but, we got to be concerned about valuation, because stocks are kind of expensive in certain respects. Well, bonds are kind of cheap in a lot of respects because of the rise in yields that we see. Back in 2023, we saw Treasury yields get all the way to a little over 5% in October of 2023. That was a great buying opportunity. in terms of buying bonds. Once it hit about 5%, and we saw treasuries trending lower, concerns about the economy going into recession. Treasuries love an economic recession. You want to have a great return in your bond portfolio, let the US economy go into recession, and you'll see double-digit returns in your bond portfolios in a lot of cases. The key is that recession can't come with inflation. Because bonds don't like inflation. So if it's a normal recession, you'll see bonds rally. And that's what we were seeing going all the way back to October 2023. We saw the 10-year Treasury yield drop from 5% down to 3.6%. That's like a 15% total return on your bonds, on your treasuries. Well, what we've seen here since September is that it's risen from 3.6%, and this was literally the day the Federal Reserve cut interest rates by 0.5%. The 10-year Treasury yield started to rise. And one of the things that we've seen since December is that it broke out above this downward sloping trend line that has existed going all the way back to October 2023. So here is the key juncture for bonds at this point. If we see a renewed rise in inflation, well, this 10-year Treasury yield could push up above 5% and maybe even towards 6%. But if those inflation lines continue to trend lower, like we saw in that previous chart, I'll even pop back up to it if my computer will cooperate here for me. Here we go. If these three lines continue to trend lower, or even if they flatten out in that 2.5% to 3.5% range, giving the Federal Reserve the flexibility to lower interest rates, this could be one heck of a buying opportunity for bonds as we go into 2025, particularly the backup that we've seen in yields here recently. So to Paul's point, we had a bull market in bonds, in treasuries, that started in 1981. And for 4 decades, bonds steadily rose. And there was some volatility along the way, but it was a bull market where they were steadily rising for 4 decades. Well, that bond market ended in 2022. But we've seen bond yields come up a lot since then. And maybe more of a trader's market for bonds through the remainder of the decade. But that doesn't mean that there's not going to be points where there's really good opportunities to buy bonds. And we could be heading into something like that right now as the new year gets underway for bonds. So, there's some challenges for bonds, but there's also good reason to be optimistic for the bond outlook as we go through 2025. All right. So I'll stop sharing there for a second. Are there any, Steve, you've had a bunch of great questions. Are there any other questions that Steve, do you have or anybody else might have at this point?
Yeah, Eric, I got a question for you.
Absolutely.
Given the rosy scenarios and also the risks that you talked about within the stock and bond market, do you think 2025 is a year where staying the course is key, or are there specific adjustments or opportunities out there that we should consider within portfolios?
No, that's a great question, Preston, because one of the things that we have historically seen, I led off the presentation by saying that politics don't matter, and they don't. But where we are in the political cycle matters, and that is a key point to keep in mind as we go through 2025. Is that historically, the first year of a presidential administration, whether it's Republican, Democrat, Green, Libertarian, or any other, the first year of a presidential administration, the stock market has historically performed well. I'll add a little bit more sauce to that goose by saying, the stock market has done particularly well in years when you have had a sweep in not only the presidency, but the Senate and the House, when you get that three-way sweep. In 2020, we saw that with the Democrats. In 2009, we saw that with the Democrats as well. In 2016, we saw it with the Republicans. And in 2024, we've seen it with the Republicans. Or 2017 and 2025, you tend to see markets have historically performed particularly well. And the reason that is because if you have one party that's in control of fiscal policy, they can actually do stuff. And the things that they're doing tend to provide liquidity to the markets that help, they're spending on things, which will help stock prices to rise. So that doesn't mean we're not without risk, because if the government's spending on things and they spark an inflation problem, well, then that's a big issue. So that doesn't mean that we're in the clear, but it is a year that makes sense. And I always refer to it as changes on the margins. adjusting portfolios along the way, not making wholesale changes, but tweaking weightings, increasing weights to certain areas of the market where opportunities present themselves at any given point in time. That's the way the 2025 sets up. Now, that doesn't mean that we should get complacent because, we do have that inflation risk that hangs out there, and we got to keep a close eye on that. That's something that might warrant a larger change in allocations or strategy. It's not transformative, but you might be adjusting more in response to an inflation outbreak. The other thing that we need to keep in mind too is that if we go back to that presidential cycle theory, the first year of a presidential cycle tends to be strong for markets. The second year of a presidential cycle tends to be pretty lousy for markets. 2018, 2022, 2014, 2010, you can go all the way back, and 2002, you can go back in time and see that the second year. So that's one of the things that we'll need to be watching too, is that even if we stay the course and we're only making changes in the margins as we go through 2025 and those risks stay under control, we need to keep an eye as we look out into 2026 to say, okay, what adjustments do we need to make if that cyclical pattern continues to repeat itself going forward?
Awesome. Jeff, I see you got your hand up.
I do. Thank you. Hey, it's nice. This has been educational. We were talking about the presidential or the government cycle, yes, no type thing. My question is, somebody who lives in the DC metro area, how does the lack of a real budget and the continuing resolutions impact the markets, right? Because for those of us who live around here, we see these consistent continuing resolutions, right? So there's no funding that happens in certain places. I'm more curious, right? Like, how could that impact it?
No, that is such a great question, Jeff. And I didn't get into the details on it, but you nailed it right on the head with that question, is that we've seen this pretty sharp rise in treasury yields going all the way back to September of 2024. And the question becomes, all right, well, what's driving that? Yeah, there's a worry about inflation and maybe the economy is going to be stronger than expected and maybe the Federal Reserve's cutting too much. But there's also a fundamental reality that's accumulating in Washington, which is that, I think about when I started in the industry and the federal budget debt, the national debt was like 5 trillion and everybody was wringing their hands about it. Well, now, now we're pressing north of 30 trillion in terms of the national debt, and it continues to rise. I talk about how corporate earnings are important to the stock market at any given point in time. One of the things that hardly ever gets talked about in terms of the markets, because it has a long-term effect, is demographics. And there is a structural reality that we have a baby boomer generation that is increasingly retiring and going through later stages of retirement, with a much smaller generation X that is, not able to generate the tax revenues in order to support this much larger baby boomer generation, that is, going to increasingly be tapping into the entitlement programs, Social Security, Medicare, Medicaid. And then there's also national defense, not to mention the interest that we're paying on our debt. So one of the key things to watch here as we go through January, the new administration comes into play. We get, the joint sessions of Congress. What happens from a budget standpoint? Because if we get clarity and we get direction in terms of, the fiscal budget, the federal budget, and what that's going to be, the bond market should react very positively to that, and then the stock market as a result as well. But if it is a situation where, like you just described, we continue to be in, like continuing resolutions and kicking the can down the road and not really getting any budgetary clarity, the bond market's bound to not like that. So that's going to be another key variable to watch in the coming months, is that what do we see from a budgetary standpoint? I would go so far as to say, I talked about how bonds represent good value right now. If getting clarity from a federal budget standpoint could be the catalyst that could really drive a bond rally, and set a floor for bond prices and really catalyze that rally. So that's a great point that you raise.
You talked about demographics. On a global level, not just the United States, isn't there a drop in birth rate in industrialized and all China, Russia, Great Britain, all of them, Europe? What does that do to consumption? And what is, the lower consumption does to productivity and to profits?
Yeah, I mean, it's such a great point because you're absolutely right, is that if you look at demographic trends in the United States, it's alarming. I think about myself. I have a high school age kid and middle school age kid. My sons were born in 2007 and 2011. And it's going to be a lot different for my older son going to college because he is at what's known as the demographic cliff. Colleges and universities have been preparing for 2026 and beyond for years because we had the financial crisis back from 2007 to 2009, and people started having fewer kids. And then when the financial crisis ended, they had even fewer kids. The birth rate just continuing to decline. And that's not only true in the US, it is true around the world. A good place to look to see what the long-term effects of an economy getting older is Japan, because Japan was at the front end of their economy just getting old and their people getting old and their birth rates declining. Japan has struggled for decades in terms, they were at once the second largest economy in the world. Well, now they're the third largest economy and fading. They've had some good performance here in recent years from, an economy and the stock market perspective, but that was after a long malaise. Another place that has been talked about for years more recently, that is going to face an increasing challenge is China. The one advantage that Japan had is that Japan got rich before it got old. With China, it's gotten old before it ever got rich. And, in 1978, it seemed like a really good idea to institute a one-child policy to help their population growth from running out of control. Well, they're now facing the 4-2-1 problem after, about 40 years of that one-child policy before they finally abandoned it. You have one child that's supporting two parents and four grandparents. And that is going to be an increasing drag on the Chinese economy, and is likely to see a shift in terms of global leadership. It's going to be slow to progress, but something that we'll continue to see materialize likely in the first half of the 21st century, or the second quarter of the 21st century. The one economy that really stands out in contrast to that, of course, is India. India, surpassing China as the largest economy of the world in terms of population. And they have a lot of advantages that China did not have in terms of education. They have a lot of structural challenges, to be sure. You think about, transportation infrastructure and things of that nature, as well as, political red tape is unbelievable in India. But that will be a key theme to watch. An increasing drag for the developed world, but an increasing opportunity for a lot of areas of the emerging and developing world. All right, so I'm going to pop back to the presentation because it's always, we've covered a lot of ground. So just to kind of go to, those final closing points here, just some of the key conclusions. So, as we talked about, the outlook for stocks, favorable in the coming year. A lot of good reasons for optimism, and a lot of that's being driven by an economy that remains persistently strong in terms of economic growth and corporate earnings that continue to expand. The bond market's been a little bit more uneven. It's been a little choppy over the last few years. I mean, that's, when you end a four-decade bull market, it's bound to be a bit choppy. A key to watch on that front is going to be the inflation, the interest rate outlook. But if we get inflation that continues to trend in the right direction and the Fed starting to talk about more rate cuts in that context, it could be a good year for bonds. But as we talked about, for stocks, for bonds, it's even going to be true for things like gold and some more, more alternative areas of the market. Corporate earnings on the stock side, inflation on the stock and bond side, those are going to be the real keys to watch in terms of what types of adjustments that may need to be made along the way as we go through 2025. All right. So, are there any final questions that people may have, in terms of the things that we talked about here tonight?
I know we're a little past time and very much appreciate everybody popping out tonight and, hopefully learn something a little bit. And I'll ask Eric a couple of questions if you want to hang around. I won't be offended if you drop off, but there are a couple of things that I always like to talk about when we have these opportunities, and one of which relates directly to client portfolios. Eric, and we talked about this yesterday at the investment board meeting. So maybe you could shed some light on some of the changes that, we're making at the portfolio levels to adapt to all this stuff that's going on in the world, because this is the stuff that hits home. People are going to see on their statements if they actually turn to the detail pages, and might help them understand some of the work that actually happens behind the scenes, where we're not just buying the index, and what happens to when we actually enact those changes.
Yeah, no, it's a great question. And I'll share with the group that, Paul and Preston are, value partners on Great Value Advisor Group side. They really help us in terms of how we manage the portfolios and helping us, really have our, a better finger on the pulse in terms of the things that you as clients want and need in your portfolios. So it's really, I mean, it is really a great mutual relationship that we have. And, as Paul mentioned, we had our latest investment board meeting in January. So Paul's a voting member of the investment board. So nothing happens with our models without, Paul and the rest of the investment board reviewing our recommendations from the asset management team to say, okay, this is something that sounds good and makes sense, or no, this is not a good idea, or something that should be reevaluated. So some of the changes that came out of yesterday, kind of adjusting to the environment that we're seeing as we go into 2025. One of the things that is, and Steve, you mentioned that AI boom that we've seen that's really going on about, it's about 20 months now. It was May of 2023 when this really got started in the markets. There's been a tremendous amount of concentration of returns in the stock market over the last 20 months. In a normal year, the S&P 500 made up of 503 stocks. In a normal year, as you would expect, roughly half of the stocks in the S&P 500 will do better than the S&P 500. They'll outperform the S&P 500, and the other half underperform. Well, in 2023, only 38% of stocks in the S&P 500 outperformed the S&P, which means that 62% of stocks underperformed the S&P. That was highly unusual. Well, what did we see in 2024? Only 27% of stocks in the S&P 500 outperformed the S&P 500, which, means that 73% of stocks underperformed. Now, what does that mean from an opportunity perspective as we go into 2025? That's a tremendous amount of concentration, which means there's a small set of stocks that have done really well, and the rest of the stocks have kind of trailed behind. Well, in an economy that continues to grow with corporate earnings rising at low teens rate, that suggests that there's a lot of companies in that 73% that have a lot of room to catch up to the upside. So we're still allocating to that group, that 27% that did great, but we are, also focusing our efforts and our time on that 73% that, if we get back to a normal market environment where 50% of stocks outperform. Since July, we've already been seeing this. A lot of the stocks that outperform in the coming year could come from that 73% that trailed in 2023, or the 62% that trailed in the year prior. So some of the adjustments that we made to the portfolio kind of reflecting that. One, it's, in terms of, certain exchange traded funds, previously we had used some individual stocks to cover certain areas of the market, in certain client portfolios, using exchange traded funds, or basically, it's like a mutual fund that you can buy and sell on a stock market exchange to get broader coverage in our portfolios to capture that broader universe of names for the client accounts. Another is, we have what's known as a SMID manager. You hear about mid-cap stocks and small-cap stocks, those potential up-and-comers in terms of when you have an economy that's growing. We have a new manager that's coming into play that is covering both the mid-cap and the small-cap space. And part of the idea there is that if they find opportunities in small cap stocks that they run into the mid cap space, that manager can continue to own them and maybe even add more to that allocation to them, as opposed to if you have separate small and mid cap managers, a small cap stock does really well, it runs into the mid cap space, and then it has to be sold on the small cap side and bought on the mid cap side. Well, we have one manager now that's going to cover that space, and they can identify the best companies in that space through active management. A third element, and this is another area that you hear a lot about, it has been a great time to invest in the United States for a while now. I mean, really going all the way back to April of 2010, the US stock market has dramatically outperformed developed international, Europe, United Kingdom, France, Germany, Japan, those kind of countries, as well as emerging markets. So that's like China and Russia, and well, not Russia anymore, but India, Brazil. Well, what that has created is a tremendous valuation disparity where US stocks are now much more expensive than international stocks. This has been true for a while, though. And so we don't necessarily want to invest in international stocks just because they're cheap, because they could become cheaper relative to the US before it's all said and done. So we have added a manager. It's a global manager that has the flexibility. If they think the opportunity, like that the tide is finally going to turn and international stocks are going to do better, they can increase their weight to international stocks. If they think that the US is going to continue to do better, they can increase their weight to US stocks. And it incorporates a flex in your portfolios so that if the tide does start to turn, you'll be able to be positioned to capitalize on a real-time basis. But in the meantime, if the US continues to lead, your portfolio can continue to participate in that way as well. So that's through a global manager that we're adding. And then the last is that it's been a really tough time for real estate the last few years. We had higher interest rates to fight inflation. The real estate prices had gotten really expensive in a lot of different markets. And then there's always the concern about office space and retail space and everything like that. Well, the fundamentals in the real estate business, there's still some concerns on the office space side and on the retail side, but real estate is a diverse area in and of itself. Industrial and apartment complexes and residential. That the outlook for real estate has become much more favorable as inflation continues to come down, as the Fed starts to lower interest rates. So adding a dedicated allocation, it's just relatively small, but still a dedicated allocation to real estate in your investment portfolios as well.
Awesome. Yeah. And those are a lot of areas that when we talk about diversified portfolios, and we didn't really spend any time today on international stocks. And I know that was something Eric highlighted. You guys have all owned international stocks in some way, shape, or form forever. And we've been strategically underweight those areas of the market for a very long time. So when Eric's talking about making a change, he's not talking about betting the ranch on that. It may be just swapping out the existing real estate position, or I'm sorry, the existing international positions for a new manager that has a little bit more flexibility to allocate even some of those funds toward the U.S. as opposed to international. So it gives us more of a go anywhere approach with the international piece. And with real estate too, many of you have owned real estate for a long time, and it was really good for a long time until it wasn't, just like anything. So we may be adding real estate in a higher percentage in some cases, or maintaining a position depending upon your specific portfolio. And one thing that Eric didn't talk about and is probably beyond the scope of this is, and Steve kind of alluded to it earlier, how do we allocate portfolios to people? So for those that taxes are a problem and we're working in an after-tax account, we need to be sensitive to just not blowing out of positions because they fell out of favor for the moment, because the tax cost may be too great to get rid of them or to trim the position size. So that does come into play when we're making these decisions. And sure, we may have to realize some capital gains in a given year, but part of our allocation process and reviews at the account level are making sure we don't blow up your guys' tax returns, because trust me, I know more than anyone, no one likes to pay extra taxes. So that is certainly part of the process as well, and considerations we have to make, not just at the investment board level, but me as the advisor over your guys' assets when it gets down to, okay, do we pull the trigger on these trades or not? And how could we do it in an efficient manner? So that all being said, you guys stuck around longer, so you either have nothing to do on a Wednesday night, or this is actually somewhat interesting. But we do appreciate this. As always, just appreciate the trust you guys have in us, and we do our best on our end to bring best in class and world class research and service and people to the table that help me do what I do for your benefit. And it's really nice to be able to bring Eric in, because he is so instrumental in allowing me to work with you guys and bringing that qualified voice. And, you know, it's not just Eric. There are other advisors like me that collaborate with him. And collectively, there's about, I don't know, 1.5 billion now or so under the care of GVA Asset Management. So, you know, it's certainly not just us that are employing Eric and the team. And it, you know, that collaborative voice and other advisors like me that work with folks like you bring a lot to the table. And we've seen just some incredible progress over the past couple of years, and very excited to be able to work with him and the rest of the team at GVA. So it's been a very good relationship in that respect.
Yeah, no, and yeah, it's been great. And just to, you know, add on to Paul saying, I appreciate Paul and Preston having me on board to be able to spend the evening with you talking about financial markets, talk about the economy. If any of you have any questions, you know, that come up, you know, after the presentation, you know, definitely let Paul or Preston know, and you know, they can follow up with me and, you know, get an answer to any questions that you may have. But it's been a great pleasure to be with you tonight. I really enjoyed it.
Thank you. And if you guys want to see these more often, let us know. I know we don't do them too frequently because we don't want to shove market stuff down your throat. But if this is something that you guys would like to see on a quarterly or semi-annual basis, we could easily make that happen. I'll drag Eric away from his kids for an hour or so on a weeknight. But you know, we appreciate that as well.
It was a good way to jumpstart 2025, guys.
Yeah, very much so. Appreciate it, guys. That was really good. Thank you.
Thank you.
Thanks,
Everybody
Thank
had
you.
a great night.
Yeah.
Appreciate it. Thank you.
Thank you.